Besides having a cost advantage, a company can gain the upper hand over their competitors simply because it's bigger. Sometimes the sheer size of a company, in conjunction with the small size or niche-like nature of the market it serves, is enough to deter potential competitors and to serve as a wide economic moat. At a certain size, a company achieves economies of scale. This is when more units of a good or service can be produced on a larger scale with lower input costs. This helps reduce overhead costs in areas such as production, financing, advertising, etc. Big companies that compete in a given industry tend to dominate the core market share of that industry, while smaller players are forced to either leave the industry or occupy smaller, niche roles. When a company has a relatively exclusive monopoly, for example, it means it controls the supply of a particular product or service within a certain location or industry. This makes it very difficult for similar companies to get a foothold in the same market, since the established giant in the neighborhood has already claimed most of the available customers and has sufficient size and resources to do whatever it takes to hang on to them. In addition, when a company is big and it has lots of cash flows, it's much easier for it to grow by simply acquiring other businesses. A good example is Apple. For example, if Apple wants to develop a new headphone product line that will be used for upselling and increasing their lifetime customer value, they simply go out there and buy an excellent headphone business. And yes, they actually did. Apple bought Beats in 2014 for over $3 billion. And now they have great headphone products to sell in their stores without spending too much time and effort building them. It may take Apple's competitors years to build the same headphone business. And of course, they'll have to do a lot of work. By having a size advantage, Apple is clearly doing better than its rivals. So, as a value investor, you'll want to invest in companies with a size advantage. In the next video, we'll dive into how a company can create an economic moat with its intangible assets. See you in the next video. Okay, in this video, we'll talk about the possession of unique assets. Another type of economic moat can be created when a company invests in developing and building its own intangible assets. Examples of such assets include things like patents, a strong and widely recognizable brand name, copyrighted intellectual property, and specialized permits or other kinds of government-issued licenses. These types of assets provide a natural economic moat for the company's continued and profitable business operation. Strong brand name recognition allows these types of companies to charge a premium for their products over other competitors' products because they offer customers something that's limited, exclusive, or difficult to replicate, as well as something that's often known for having a predictable level of quality. The perfect example might be Nike, which started out as a simple athletic apparel company but has since become a major cultural institution and a purveyor not only of gear but of status. Designer fashion labels have similar business models, using their prestige to sell clothing for prices several times higher than the cost of production. Not only does intangible assets help a company survive in the long run, they also help prevent other competitors from duplicating the company's products because they are protected by copyrights and patents. In addition, I want you to take note of this. Popular brands aren't always profitable brands. If a brand doesn't entice consumers to pay more, it may not create a competitive advantage. That's a red flag telling us that the management is not doing a good job to increase the business earnings and cash flow. From an investor's perspective, a popular brand means nothing to me if it's not profitable and if it doesn't show any promise for future growth. As an investor, what we care about is how we can make a return on our investments. If a business is not profitable, our investment won't be profitable, and we'll likely take additional risks of losing our money. So make sure you pick your stock wisely. In summary, you should look for companies that are protected by the advantage of a premium brand name, a tightly licensed product, a loyal customer base, and an industry with extremely regulated and complex entry requirements. And you also want to make sure the company's management knows how to utilize these intangible assets. In the next video, I'll talk about the network effect, which is another way an economic moat can be created. Okay, see you in the next video. In this video, we're going to talk about the benefits of the network effect. When a business has the built-in ability to both grow and improve as it gains more customers, it is said to benefit from the network effect. In these cases, the more people who use a certain business, the bigger its market share gets. But more importantly, the more exclusive its hold on that share becomes. This is simply because having more users translates into a more valuable product or service for all, and inherently leads to a never-ending cycle of continuous growth. The network effect is an extremely powerful type of competitive advantage, and it's most often found in businesses based on sharing information or connecting users together. You don't see it much in businesses that deal in physical goods. Examples of this can be seen in companies such as eBay, Visa, and Facebook. The more people who use these particular services, the better the experience becomes, which leads to more people using the services. The network effect gives a company a lot of advantages over its competitors. Looking at Facebook, for example, Facebook becomes more and more profitable when more people use it. You know what? Facebook has access to a database of billions of people around the world. So this means they can easily make billions of dollars just by utilizing their customer base. You see, the network effect makes it hard for other companies to compete with Facebook, because if they want to enter a competition, they must spend a lot more money on advertising and a lot more effort on reaching more people and showing their products. In the case of Facebook, they can reach billions of people without any hassles. You can guess who will win in this game. This competitive advantage can be difficult to dislodge once it gains momentum, and so it offers a potentially enormous economic moat to the lucky company or two that managed to establish the first successful networks in a particular industry. So make sure that you'll look for companies with a strong network effect. They are always winners in their industry. In the next video, we'll talk about how a company can create an economic moat by commanding high switching costs. Okay, see you in the next video. Okay, the final way a company can go about building a sustainable competitive advantage is integrating high switching costs into their business. Switching costs are expenses or disruptions a customer will encounter when switching from one product or service to another. It's beneficial for companies to create high switching costs, as doing so can help them retain customers. Cell phone service providers, for example, can lock in customers because of their high switching costs. To change providers, a customer might need to terminate an existing contract and purchase a new phone, both of which can be costly. As such, customers might be less motivated to switch providers even if they're dissatisfied with their current service. You see, how well a company is doing is determined by its ability to maintain its customer and supplier base, regardless of how fierce the competition is. When a company provides a customer with a product or service that is difficult to break away from, in terms of cost, time, or convenience, it's far more likely to hold on to that customer over the long term. And this makes competition more interesting, because if the company's competitors want to gain more market share, they must offer an extremely attractive price or performance alternative to entice consumers to switch from their current provider. Their competitors will have a very difficult time taking market share away because of these cumbersome switching costs. You know, in many cases, customers just aren't interested in dealing with the fees or aggravation involved in making the switch, regardless of how appealing a competitor's offering is. Not only does this fact allow the company to maintain a strong customer base, it even makes it possible for them to incrementally raise their user prices over time, in order to consistently increase their profits. That is to say, when a company is able to establish itself in an industry, it can have higher pricing power over its competitors, and this is something that will help it survive over the long run. So, as a value investor, make sure you'll look for businesses that are industry leaders, and they know how to integrate high switching costs into their operating and marketing practices.
Thank you for watching, and let us know your thoughts in the comments below. Check out the offers in the description for more surprises. Please make sure you give this video a thumbs up and subscribe to our channel. Don't forget to check out more exciting videos in our channel.